Hi all, welcome to Free Float. I'm Shyam and I have Kishan with me.
Hi, Sham.
Today we are going to be talking about probably the most important thing for investors, and that is the difference between gross returns and net returns. So Kishan, you want to start us
Yeah,
off? Yeah.
yeah, sure. So, I think th- is it this is something that I think most people miss out, or there's some people who are like aware, don't realize how much of the returns uh, get eaten up by you know um, by say transaction costs, one, which are the I mean the I mean the you could say uh, it's the cost that you pay to play in the casino. It's what you say is the rake. You know you know if someone plays poker, they'll understand that. It's a cost that pay the broker and the government. They both take up a lot uh, uh, of your alpha that you think that you generate, and alpha gets taken away, and what you're left is with the net return, which often is not as as high as you I mean you know I mean it's definitely not as high as a gross return, but the net return ends up being not as exciting as a gross return as might have been. And
Right.
this is especially true for for strategies which are like frequently traded, where
Yeah,
you
absolutely.
trade every
And
day.
I think there are a couple of reasons for this. So one is calculating net returns is not easy, right? The information is in different places. So if you are a regular trader, you will know that okay, so every day I trade, I get a contract note, right? So your exact cost, uh, is unknowable until you get it because there
Yeah,
are a whole bunch of moving parts there. Whether you did any intraday trades, how your broker is going to calculate, um, you know, the uh, uh, the actual brokerage, the
yeah,
GST component of that brokerage, the different fees. The post actually walks you through the different taxes
yeah,
on every transaction, and I only covered those uh, transaction costs that are a percentage of the notional transacted because they end up eating away a big chunk of it. So think about it this way: say you trade 1 lakh notional, right? So it could be buying 50K and selling 50K, or just buying 1 lakh, right? Now, if your fees were just a flat $20, no matter what you did, right? Then the larger your
that
account,
will be, yeah,
yeah, the lower that bites you.
as a percentage. Yeah,
Yeah. So this is why we sort of encourage our investors to have larger balances because there is a fixed fee per trade component, which CDSL charges and maybe even your broker charges. So as a percentage, it reduces, but that still does not take away the bite that you feel from the transaction taxes and costs. And
yeah,
it looks like everybody has their hands in the till, right? So the central government wants something, so they charged STT, which is by far the biggest fee on transactions, right? It's like
yeah,
0.1%. So every time you transact, the government eats that. And then you have your SEBI turnover fees. Then you have your stamp duty. Stamp duty goes to the state government. STD goes to the central government. and in between you have this SEBI who's who's going to take a bite out of that, and then you have the stock exchange, uh, who is like, okay, hey, I'm NSE, I'm BSE, so you transacted this stuff on my platform, so I'm going to charge you a fee for that. So after you pay all these fees, you still need to pay capital gains tax at the end of the year, right? Which is insane. So not only are you paying, a tax which is a percentage of notional traded, whether you made money or not, doesn't matter. Right? You've already paid the tax. On top of that, if by some fluke you actually made money at the end of the year, the government is like, okay, I want 15% or 10% of it or whatever. Right? So there's this component, and it is charged at different stages of your journey. So it doesn't come at you in one shot. So it's difficult to calculate. And most investors kind of gloss over it because it is difficult. So why do it? Right. And this sort of, behavior is sort of exploited, I would say, by people who keep touting their investment strategies on social media and so on. Right. Because, they keep saying, look, I outperformed mutual funds, right? But what they don't disclose there is that the mutual fund NAV that you see incorporates all these charges.
I mean, all these costs,
Yeah, all these costs. So the only thing you pay is the long-term capital gains when you redeem your units.
Mutual fund.
Yeah. So
also, I think there's a bit of no one even mentions it, that is, it's gross return or like net return. I think that's also like a layer to it, that most people do not mention if it's net or gross. I think I mean there's no disclaimer, there's not even a link which says, okay, here if you click, we will explain whatever return it is.
Yeah,
I think most people don't.
Yeah, that is because of an even more devious problem. Because most advisors, I don't want to paint all advisors with the same brush, but most advisors treat it as a collection of stocks versus actually maintaining a portfolio.
Right, and I think even if they just had a model portfolio, and they gave you an estimate of what they think the cost is, even if it's a not a traded portfolio, but they incorporated as if they took into those costs. And I'm not even talking about implicit costs like slippage and stuff. I'm just saying all the explicit costs. You can take off, you can estimate those things to a great degree of accuracy. And you say that the actuals might still vary, and you are honest about it and upfront about it. I think that will make a big differentiation on how people perceive you. Because then you're and as an advisor, you will actually come across as an honest bloke.
Yeah, absolutely. So the problem is if you don't disclose this, right? So all you need from the advisor is the churn, right? What is your monthly churn on average? That is enough. So with that, you can back into what the drag is going to be because of transaction costs based on your circumstance. And most people don't even publish that.
Yeah. Right? Yeah, and I think that's not sufficient, because what happens if you do that is most people would not be able to visualize. If I tell you, okay, I chose 7 stocks in a portfolio, for me to go and understand how much that means, I'll have to go to Excel and make a a model almost that that takes into account all the transaction costs, which takes time. And so I mean, and I think not everyone is an Excel.
Yeah, so that's why we set up a Google Doc. So let me walk you through it. Let me just share my screen. Can you see it?
Yes.
Okay, so the table on the right gives you a model based on churn. So let's say your monthly turnover is 200%, which is 200% is basically you're selling all of your
All your
portfolio
stocks.
and buying it back, right?
Right.
Buying an equivalent amount back. And this is arguably the worst case scenario. So most of the time, unless only if you're running a very aggressive momentum strategy that you will see churn more than 200%. But let's say that it's 200%, and your gross return is 20%. So this is before transaction costs. It's probably what your advisor claims he's generating for you. Now, this spreadsheet sort of walks you through, assuming that you generated this $100 became 120. What is the STT you paid on it based on your churn? What is the exchange transaction charges you pay, stamp duty, etc.? And it turns out that almost 17% gets eaten away by by just transaction costs, and your 20% returns becomes like a 14% returns after you paid your short-term gains tax, etc.
Right.
So
and yeah, and I think I mean it just shows you that 5% is is like eaten away.
Yeah, so
Fine.
yeah, so you can play. I have shared the spreadsheet and linked to it on the post. So you can basically copy paste this onto Excel or Google Sheets or whatever, and walk yourself through different scenarios. Now on the left, it's basically what we started the conversation with, right? So before you go around bashing mutual funds and proclaiming the superiority of your direct equity strategy, know your rates.
Yeah.
So let's say both of those strategies, both mutual funds as well as your direct equity strategies, generate 20% before your capital gains tax, right?
Yeah.
So 20% is what comes after you paid your STT, your transaction costs, and SEBI turnover fees and stamp duty, but before the capital gains tax, right? Now, if you just say that I'm going to invest for 10 years and see the difference between the cumulative return of your direct equity strategy versus a mutual fund. Because in a mutual fund, that 20% return is compounded without taxation. It is tax-free compounded. So every year, that delta that you have compounds itself, right? So the cumulative effect of it after 10 years is humongous.
Yeah.
You end up with a far larger return with mutual fund compared to direct equity. Everything else the same. Is just the effect of capital gains tax. So this is why I feel every conversation that you have with your advisor should have a component which says, what is my expected drag because of all these taxes and fees and charges that I'm going to incur because of this direct equity strategy that I'm executing.
Okay.
And not only are you responsible for paying these taxes yourself, you could be in a situation where you will hit a mandatory audit requirement. So that is a further outgo of
and
fees.
It's a pain. And it's a pain. I mean, doing an audit is a pain.
It's a pain, and it requires commitment. because I mean, as someone who's in the capital markets for a while, you sort of say that, okay, this is my destiny, and have all the things in place, for this, because it's not a one-time thing, right? Income tax can come after 10 years down the line as well. So you need to retain all these documents. You need a CA who is competent and who is not trying to maximize your returns, and who is actually on the right side of being safe. So you need to audit your own CA to make sure he's not pulling a fast one on you. So all those things need to be in place, and you need to commit. It is not something that you take lightly. It is a fairly involved decision-making process. So, so you have that, and then this does not include your Dmad charges, because, like I said, Dmad charges are like a flat rupee fee. So, since it's not a percentage, expense, it's unlikely to be a big component of your drag. Then of course, there's a fee that you pay your advisor, and fee that you pay your broker, and so on and so forth. So so those things tend to be flat, so it's not bad. But hopefully with this spreadsheet, right, you can take this and model out whether an advisor's gross return makes sense to you after after fees, taxes, and brokerage and so on.
Right. So I would say that one thing is that if you see most advisors, they never put their return, the gross return, assuming it's gross return, it's never 5%. It's always like it's not a 5% alpha to mutual fund. It's like something much higher.
Yeah, absolutely. Right? So see, the thing is, as a consumer, you're well within your rights to ask these questions, right?
Yeah.
And the advisor should at least provide you with the historical churn that he has seen in the portfolio. So obviously there are some portfolios that rebalance once in a year or once in 6 months or whatever. Yeah. So that is not a so in those situations, all you need to worry about are your capital gains tax, which still is a drag, but at least it is not something that eats away your portfolio every month, right? So it is you pay it only if you actually generate any capital gains tax, whereas the other fees are on transacted notionals. So whether you make money or not at the end of the year, it is still a net outgo.
Right. Right. Yeah. And I think that more than I think it's important to be aware, and it's important to to take a more informed call, and this is what we're trying to do. It's not to say that that mutual funds are better than stock advisors. If you believe that, we would not be doing what we are doing, because we do believe that we add value, and like mutual funds are not for everyone. But I think this thing about gross and net return, I think especially among many advisors, do not talk about it, and I think some clients realize this a bit late, that there's this component to investing directly, that you have these added costs and the added time that you have to spend, especially if you have to do an audit. That's it takes a few days.
Yeah, absolutely.
Of your time. Yeah,
and it's not free.
And so yeah, it's not free, and it's like getting a going to a doctor, and the doctor asking you uncomfortable questions, and then you realize, why am I doing this? Yeah.
Yeah, absolutely. So,
Yeah.
this I feel that most investors who, especially those who started recently, um, don't quite understand how these things kind of combine to create, a suboptimal outcome. So,
Yeah.
use the spreadsheet as a jumping off point, and see if you can, you know, sort of model out whether an advisor's, process, his rebalance frequency, and so on, is suitable for, for what you're looking to achieve.
Yeah. Yeah. I think yeah. I think that's a. I mean, that's the right way of like putting it.
All right. So with that, I hope we kind of covered most of the things when it comes to gross versus net. Did we miss out any fees or any quotas there, or did we cover everything?
No. No. I think. I mean, I would have added implicit cost, but
Yeah,
that's
that's
something that because when you talk about stock advisors, that's actually another cost that a stock advisor might buy something at at say 100, but you might end up buying at 102. But that's I mean, this is assuming that you're doing it at the exact time. So
yeah. I mean that I feel it is less of a problem uh, with equities and futures.
yeah,
But it's a huge problem in options because
yeah,
one of my clients, he came to me with this so-called track record of, of a options advisor, and it was
yeah,
mind blowing. I was like, dude, this is awesome. If he
yeah,
continues doing this, he'll overtake Jeff Bezos in 3 months.
yeah,
So
yeah,
I started digging, right? So what is he doing? So all his calls, so to speak, were
yeah.
based on end of the day prices. And
Oh
I
my
was ready to
God.
take a gun and shoot myself. I found that out. And I think there's
Yeah,
no way you can execute any of this. So forget about it, right?
yeah. No,
So, yeah,
you can't. And I mean, options are, I mean, extremely volatile, and you cannot take the end of day. I mean, that's
yeah. What is
just
what is an end of day price for an option, anyways, right?
yeah,
So
yeah,
it's meaningless.
yeah.
And so I started sharing with him screenshots. So he apparently he would email the calls to them in the morning, and they were supposed to execute. So
That's
he
yeah,
would
and I
forward
mean,
that email to me, and I would send him screenshots of the market,
the
right?
actual exact, yeah, the
It's
actual
like
execution.
there's no market for it. The option trades cannot be executed at those prices ever. So yeah, so it becomes, so these things become a problem in in the illiquid space in general, and not just options.
Yeah,
But for the most part, if you're just dealing with equities and futures, this spreadsheet is
yeah.
good enough to model it out.
Assuming that I mean, over the long run, things would average out.
Yeah, it should.
Yeah, because
Yeah,
I mean, you might get one bad price today, and you might get a better price tomorrow. If that averages out, that's great. But and that's something that you cannot really model really well. You just have to take an assumption at the most.
yeah. And over here, I think there are different ways in which you can minimize this drift. So for one thing, don't rebalance in the first half hour and the last half hour of the market. The prices tend to be extremely volatile. You can pick a spot somewhere in between, between 9:45 and
Eh,
2:30 or something,
Except,
and 3.
except, except, I do the opposite, and the only reason I do the opposite is because volumes.
Uh, yeah, I guess it depends on what you're trying to optimize for. Um,
Yeah,
so I prefer the 2 p.m. Rebalance for equities. Things are the most stable at that point. So there's, you know, uh, I think most people just take a snooze. I don't know, but prices don't jump around that much around too. So when you rebalance, you get a price and you can actually execute it within the next 15 minutes and get very close to it. So it's only during the first half hour and the last half hour that you get a lot of fluctuation. But you're right about the volumes. So if you want to trade size, you do it at the end. So yeah. So anyway, I think it's too much in the weeds for most people, so we'll stop here. And I hope you guys find the spreadsheet useful. Feel free to kind of copy paste it to your own spreadsheet, modify it, change it, and just model out what you're exactly in for. So until next week, thank you for watching our show. See you again next week. Bye.
Thank you. Bye.